This is Gerardo Del Real with Resource Stock Digest. Joining me today is the president and CEO of Revival Gold, Mr. Hugh Agro. Hugh, it is great to have you back on. How are you this fine day, sir?
Excellent, Gerardo. Great to be back with you.
Well, listen, let's get right to it. Gold right back over the $5,100 level. Silver right at the $84 level. The dollar seems to want to break down here. It's down below the 97 level. And I just read a congressional report, a nonpartisan one, by the way, that estimates that within a decade, the national deficit here in the U.S. will be $64 trillion. So I say that to say that I think we have a pretty substantial case that can be made that gold and the precious metals continue a lot higher. You, within that backdrop, are putting out news that not only validates the continuity of Mercur, but also now is poking at nearby extensions. The first time you've been able to do that because the land package, the way I understand it, was fractured for quite some time. Can you speak to this latest release where, among other hits, you hit 30 meters of 1 gram per ton gold, extending the mineralization there?
Yeah, well, let me start with your comment about the price of gold. Look, we come at it from the point of view that there just are not a lot of new gold projects in good geographies to feed future production. And this has been our thesis for, now a dozen years. But if you look at the pace of discovery, it's at abysmal lows relative to that continued pace of global gold production. So running at about 5-6 times the pace of discovery. And I note one of the commentators observing that there haven't been any discoveries of note in the last couple of years, let alone in good locations. So we start with this as an underbasing thesis, and I don't think the price of gold moves down significantly at all. In fact, I think, as you're proposing it's going to continue to move up, and for good reason. And so we're in this great location here in Utah with the Mercur Gold Project, 1.6 million ounces, in Idaho with the Beartrack-Arnett Project, 4.6 million ounces. And to your point, we're getting, excellent results out of the drill bit here. This is a solid deposit. Will generate at the Mercur project in Utah, generate about 100,000 ounces a year, 10-year mine life, and we're drilling to advance that project. But also with these holes, we're showing the expansion potential. And what's really interesting about it to me is that we've already done the basic geology around soil geochem analysis, geophysical analysis, structural analysis, which shows that we have potential for an expansion of the deposit in the main Mercur area. But these drill holes are physical evidence of that mineralization beyond the existing pit shells. And that is validation of, a lot of upside in the story.
No, listen, I would be remiss not to mention that you have not just one asset that I really like, the near-term production optionality, obviously there with Mercur, which I think you're going to hit the sweet spot of the profit cycle, but you also have a very exciting exploration project over at Beartrack-Arnett. Can you touch on that a bit more?
Well, it's option value, right? And the reason why investors want to, at this stage of the cycle, invest in developers like Revival Gold is that we have a ton of option value. So that comes in a couple of, 2 or 3 different forms. You can pay up as an investor right now for a producing gold company, and you'll pay up. By pay up, I mean you'll pay a price to underlying net asset value of 0.7 to 1 times net asset value. Or you can go take a bit more risk and go into a developer trading at typically 0.5 times underlying net asset value, or in Revival Gold's case, trading at a 0.1 times net asset value. So ton of upside potential moving up. And then the question is, what's the risk you're taking on to get that extra value? And in the case of Revival Gold, we're on brownfields locations. We've got a short timeline to the start of production. We've got a team that's done it before. And, we talk about option value. not only do you have the option of exposure to additional discovery through exploration, but you've got the option value that comes from all of the ounces that are not in engineering studies yet. And in our case, it's less than half our ounces, half our 6 million ounces of resource are in that underlying net asset value that we talk about. So in terms of option value for the investor, the Beartrack-Arnett upside resource there is huge exposure for investors. I mean, you just think about 6 million ounces of gold. That's $30 billion worth of gold exposure in situ. We got to get it out of the ground. We may not get all of it out of the ground, but the point is it's a lot of exposure. So every time the price of gold goes up 10, 15, 20, $100, that's, a significant leverage that you own in a developer like Revival Gold.
Oh, well said. Not going to top that. I think the case kind of makes itself, but you articulated it brilliantly. Hugh, great to have you on. Excited to have you back. Lots of catalysts to come in 2026. Looking forward to it. Thank you again.
All right. Okay. Thanks, Gerardo.
Hey everybody, Gerardo Del Real here. If you're enjoying the content that you just saw, you can let us know in 3 simple steps. Hit the like button, hit the subscribe button, and please share across your network and on social media. Take care, everybody.